The impact of commodity ETFs on spot prices. Manipulation or natural trend commodity exchange traded funds, ETFs, have become one of the most popular investment vehicles in recent years. By allowing retail and institutional investors to gain exposure to commodities without physically owning them, ETFs bridge the gap between financial markets and real-world assets like gold, oil, and agricultural products. However, a critical debate persists. Do commodity ETFs distort spot prices through speculative flows, or do they simply reflect natural supply and demand trends? The mechanism of commodity ETFs. Commodity ETFs operate by either holding the physical commodity, e.g., gold-backed ETFs, or by tracking futures contracts, e.g., oil and agricultural ETFs. When demand for ETFs increases, fund managers are often required to buy the underlying assets or futures, potentially influencing spot prices indirectly. This link between ETF demand and commodity pricing raises concerns about market manipulation. The case for manipulation: critics argue that commodity ETFs amplify price volatility and create artificial demand. For instance, during periods of financial uncertainty, sudden inflows into gold ETFs may push spot prices higher, not necessarily because of changes in physical gold demand, but due to speculative buying. Similarly, oil ETFs rolling over futures contracts can cause pressure on specific maturities, distorting the natural supply-demand balance. The case for natural trend. On the other hand, proponents of ETFs contend that these products merely reflect investor sentiment and act as an additional channel for capital flow. If spot prices rise due to increased ETF demand, it can be interpreted as a natural trend driven by risk perception, inflation expectations, or hedging needs. Rather than manipulation, ETFs may serve as a transparent barometer of real-world market psychology. The impact of commodity ETFs on spot prices remains a double-edged sword. While they can intensify short-term price swings and create temporary distortions, they also provide liquidity, accessibility, and efficiency to commodity markets. Whether manipulation or natural trend, the influence of ETFs cannot be ignored, making them both a risk and an opportunity for traders and policymakers.